Everyone, this is Rahul from the Alternative Investors Hangout, and today we have a returning guest, John. He's been on some of my older videos. John, long time no talk on this channel.
Hey, thanks for having me back. Yeah, definitely. It's good to catch up.
Alrighty, so you know, the stock market has been on fire, over the past year, and we know that the collectibles market as well. I interviewed you on my sports card channel, and sports cards went up, and we were talking about the yields. The 10-year yields were going up. The slope of yield curve was going up. But we also noticed that the tech stocks didn't rally. So, what are your thoughts on all of that?
Well, generally the tech stocks haven't been rallying because of the massive increase in yields. The tech sector is very sensitive to the interest rate. Part of that is some of those companies are levered up, like Apple on their total assets to total liabilities ratio. Now, I haven't checked their balance sheet in a couple of months, but last time I checked, it didn't even have two assets to one liability, but it's paying a nice dividend. So a lot of these tech sectors, contrary to popular belief, are levered up. Microsoft is one I checked that was pretty good on its financials, wasn't too levered up, and they're pricing themselves for growth, but they're also very large companies. Like I'm just using Apple as an example. And so the increase in yields really has uh, taken a toll on the tech sector, as well as gold. And I also, one thing about the markets also is for some reason, every time interest rates rise, the financials can actually rally despite, the popular belief of a lot of the interest rate theories that Austrian school uh, floats out. But at the end of the day, the market in the short term is going to do what it thinks, not what is actually going to inevitably happen. And so a lot of people think, oh, interest rates are rising, so that means the banks could lend at a higher rate, so the financials will go up initially. It doesn't mean the long term they're healthy or they'll survive higher interest rates. Just that's what the market does. So for the tech, I would say that is the same reason gold, it's the increase in yields that has really taken a toll on it.
Yeah, you made a lot of points there, and I did notice Apple, which I own, and I am also trading via the options market. I do believe that the tech sector will pick back up, and I've been looking at, for instance, the COT reports, the commitment of traders, and I noticed that not the producers, but the speculators were aggressively shorting bonds since January through March. And it seems that they got the trend wrong at the they always get the trend at the wrong time, and they aggressively short at the wrong time. And I believe that this will, at least in the short term, this trade will reverse, and we'll see bonds rally at least short term, and this would help the tech sector and help the gold, silver, and commodity space. Do you see it like that too, or?
Yeah, I can see that. I just want to say, like, even though I was talking about the tech sector and yields, I'm not like bearish on tech, or I don't think I don't think tech's a bad investment per se. Like as you know, like I think we're in an everything bubble, but I also think, as you know, we talk about this off air. Is like inevitability doesn't mean imminent, and things could go on a lot longer than we think possible, especially in today's uh, world of central bank backstopping a lot of losses. So yeah, I think tech will do well over the next couple of years. I do think I mainly like to invest in undervalued assets. Right now, the only ones that are a lot of gold stocks are trading at like 4 times EBITDA or 5 times EBITDA. In the resource sector, I don't like the earnings metric, price to earnings, just because on down years or down cycles, they'll just write everything off so they can, uh, tax carry forward those losses. So I I like the gold stocks, but I think tech will do well. I think housing due to inflation will do well. I think a lot of sectors will do well. So like a diverse in today's world, a diversified portfolio for a lot of people will probably do serve them well. So I think tech, yeah, you're right. I can see that. And the bonds, well, the other thing too is another example of all these shorts being overly aggressive at the wrong time is my favorite story, GameStop. They shorted more shares than what were traded on the market. And the other thing too is with Reddit now being a major player in the markets, AMC, BlackBerry, you don't know, like this is a new market phenomenon, and it's going to continue, I think, especially with the stimulus checks. And I think these stimulus checks are going to be more of a permanent thing. You saw them under Trump, you saw them under Biden. They're going to be permanent, I think. So they are gonna. The Robinhood crowd is now a new major player in the market, and so I think shorting is a very dangerous sector. That's why, yeah, I am bullish. I think tech will do well, and I don't think they're gonna allow interest rates to rise too much. Too many sectors will go uh, bankrupt, basically.
Yeah, your last point about raising interest rates, and I was looking at the Fed Fund futures, and as of, the other day, it seems that the Fed is not going to raise rates based on these traders until late 2022. So yeah, I mean, I think the stock market will probably, top out or start to top out around that time, or it could be 2023, but that's what it's looking like with cycles. And going back to gold, what particular stocks are you looking at? Are you looking at ETFs right now? Do you see the sector continuing to go up in the next few years? I mean, last year, we saw gold go up, right after the March stock market crash, and it's been consolidating for the last, I would say, couple of months.
Yeah, I think it's gonna consolidate for a while longer. In my opinion, like it literally last 2 years has gone up from 1,200 roughly to its new all-time highs of like 1927, I believe. That's quite a run, and it will need some consolidation. And if you do it in that short of a time, in 2 years, that means the consolidation was for 6 months, has been 7 months. So I think it will consolidate just based on my time metrics of how I do markets. In my opinion, I think it will consolidate at least another 5 months minimum. So I don't think it's going to do much this year. Next year, it might start slowly. On the long term, though, the technical charts, it's forming a long-term cup and handle, which is very bullish for gold. And I think once that handle sort of completes, it's going to have another big run, but around 700, 7,500, not 7.5, 7 and 1/3 hundred, 1/3, $730 in 2 years. That's quite a run from 1,200. That's well over 50% run. So yeah, it needs time to consolidate. So, and I just also want to say on this stuff, this is solely my opinion. I'm not giving any type of investment advice, and I don't want you to invest based on our conversation. And I sincerely mean that. I just this is just opinion and conversation and entertainment purposes.
Yeah, for sure. And most of the people that watch do realize, this is what we believe is going to happen. And you were talking about stimulus checks earlier, and it just seems that, last year, when they gave us stimulus checks, the sports card market went on fire, gold went on fire, the stock market continued to do well. So you still think that with these stimulus checks that are going to be given out in the next, uh, you know, month, that gold would consolidate during that period as
Yeah, I
well?
think gold will. A lot of these, the Reddit crowd that benefits from stimulus checks, they go into sports cards, collectibles, meme stocks is a new term, which I think's hysterical. Pretty soon they'll have meme, candidates or meme companies in the future. It's memes are the new normal, I guess, in today's world. For better or worse, I don't have an opinion on it because memes are entertaining. But in terms of the stimulus money, I don't think it could push up tech. I don't think it'll do much to gold. I think gold is solely a play on real interest rates, and the reason it's in consolidation is real yields are rising, but inflation's not rising. It's rising a little, but not as quick as the yields are. And so once the yield market sort of tops out, I think gold will consolidate. I mean, start running again, but I don't think it's gonna top out because the Fed's not. It doesn't look like it's bringing another program in anytime soon. When I mean anytime soon, I mean the next 4 to 6 months. So I don't really see that. So oh yeah, and what stocks I look for in gold? I guess right now, like I bought some junior royalty stocks like Impress Royalties, and I that's like it has 14 developmentals and two near term producing royalties, and one company I like is Rocks Gold. It's in West Africa. Has two producing mines. Has another mine coming online. I think it's a good company, but I'm just looking at that. I haven't bought that yet, and I would like to buy it, but I think the mid tier, the gold stocks, the gold miners, they're ripe for more consolidation in the sector, meaning mergers, acquisitions, or buyouts. So I think the mid tiers will do well because the majors, it doesn't even seem like they're done consolidating yet. And one way they consolidate is they buy out mid tiers for production growth. So
Alrighty. The last topic I want to get into is when I first met you, you were really um, knowledgeable about the oil space and the nat gas space. And we've seen oil, it's gone crazy. I think last year it was what, negative $40 a barrel at one point in one of the summer contracts, and now it's what, over $65 a barrel, I believe.
oh
And
yeah,
yeah, so what's going on with that? Like, why is it going like crazy? Is it just the vaccine's out and people are taking it, so the assumption is more people will be traveling, and all this inflation is creating an upward rise in oil prices.
I think that's part of it, but I think it's a couple of things. One reason is OPEC increased a production cut, and they're not going to increase production. So that cuts supply out of the market. So even if demand stays stagnant, if you're going to cut the amount of supply, price will go up. I think the anticipation of vaccination and the country being vaxxed, um, I think that's going to be another thing. Opening up, like they always, they're saying they're opening up, where fully open up or not, we'll see. And I think another thing is they're not under the Biden presidency. They do not allow. They stopped the federal leasing of gas production on land. So I think that combine that with the OPEC, there's a lot less supply coming into the market. So I think that's, and if you combine that with states opening up and other countries possibly opening up. I did read that Germany's on lockdown or some other, but I think a lot more states are opening up than continuing the lockdown. So I think that's really what's doing it per se. And of course, as always, every easy money, inflation. So it's a combination of things, in my opinion. But I think that's what's really driving up gas prices.
Yeah. Do you think like before this bubble burst, we're gonna go over $100 a barrel again, like we did, over a decade ago?
I think it's possible. I think we'll definitely. Uh, it's possible because a lot of scenarios could play out. One is this bubble burst, and then the Fed finally does, which a lot of people in the Austrian crowd, our school of thought, expect, and that's then negative rates and MMT on steroids, and then oil goes to 140, 150. But we would have another bursting of the bubble before that would happen. So in that scenario, it would be no, we wouldn't see $100 oil before the burst. But it all, I would say that's the scenario I see more likely now. But it it's all, I would say it all depends on the Fed as always what they do. Right now, the real economy, the unemployment rate's still high. And if they open up and that turns out to be a bust, meaning the unemployment rate doesn't drop, GDP doesn't, increase drastically, and they don't raise rates, then they could go negative in their rates, and all sorts of MMT, UBI type policies come in, and then yeah, before the bubble bursts. So I see two scenarios coming out, and I see it's hard to tell because of the animal spirits in the markets. The uh, what's it called? Yeah, it's the psychology. Like, I don't think it's. I think it's obvious the world's not completely rational right now. So it's hard to tell which one's going to rationalize which scenario I think will take out. I think we'll see around 140, $150 oil again because of those policies. But before, I would say more towards after the bubble burst. So I would say I don't think because I see the bubble, everything bubble bursting over a couple in the next couple of years, and then I think the Fed's gonna break out the war chest, and then we're gonna see MMT, negative interest rates. We're gonna see all that. So I would go with yeah. I think they're gonna go. So to answer your question, I'm thinking it, I'm rationalizing it. I would say I don't think it's going to happen before the bubble burst. It would probably be more likely afterwards. That this is just my opinion. As I say again, I'm thinking this. Please do not invest off of what I'm saying. It's just an opinion, and if you do agree with it, do your own research first and consult a financial professional before.
I totally agree with that. And yeah, before this acid bubble burst, or when oil spikes up to 150, I'm sure the sports cards that I have and some of the cards you have are probably going to collapse in value. But we shall
Yeah.
see.
Oh yeah,
And
speaking of the sports cars thing,
yeah,
I remember watching your interview with Don Harold, and I just want to clear up, like, my Katie Ledecky is that I didn't spend much money on those cards, so it's like I'm not. It's all how I like to invest is I like to risk little and try to get a lot of reward. I always say you want to there's a 1090 or 90/10. And I always like to do the 1090. That means 10% risk, 90% upside. And so 10% is how much it costs, what's the value of it, the valuation. So that's all I say is like when I bought this card, it was like $2 a card. So bought a bunch of them, and if it goes up, great. If it's not, I don't get to I have to pack my own lunch to work a couple of
yeah,
days a week.
exactly. You're not going
So
to go bankrupt over Katie Ledecky. I bought 80 of her cards, I think.
yeah,
But
so
uh,
I just wanted to
yeah,
say, like, if someone's like, "Oh, John's gonna lose a lot of money or whatever," just want to let you know
what,
I did not risk that
40
much. So
bucks. You're throwing 40 bucks.
Yeah, so yeah, I just and that's my investment philosophy.
Anyways, John, before I let you go, do you still have any social media or?
No, I'm pretty much basically off it now. I do write every now and again for Seeking Alpha. I do like I've wrote about a couple of gold mining stocks. That's basically what I know, and I don't have any formal expertise in it, but I've done it for a while, so I personally consider myself an expert in it because how many people do you know walking around know about gold mining stocks? So
Yeah, not many. That's why I always have you on.
yeah, I've rarely met the only people I know personally about that know anything about gold mining stocks are you, and that's pretty much it. So yeah,
Yeah,
people I see. So Jordan Woodburn,
yeah.
he's also an expert. He taught me about looking up and explore. Right now, it's the only thing I'm comfortable with buying in larger quantities of money right now.
Awesome. All right, John. Thanks for coming on again.
Thank you for having me.